In this recording, we will work some ratio analysis problems, and we will begin with financing and solvency ratios. Now recall that financing and solvency ratios include the times interest earned ratio, the liabilities to equity ratio, and the liabilities to assets ratio. Now, the liabilities to equity ratio is usually referred to as the debt equity ratio, and the liabilities to asset ratio is referred to as the debt asset ratio. Now, let's start off with the times interest earned ratio. The times interest earned ratio is an indicator of a company's ability to pay its interest using its earnings. Now, the higher the times interest earned ratio, the more capable a company is to pay off its debts. And how do we determine the times interest earned ratio? As the name implies, times interest earned ratio is income before interest and taxes, or EBIT, divided by interest expense. Now, EBIT is in the numerator because interest expense is paid out of EBIT. We need to have the income or earnings measure before we deduct interest. So it is that income or earnings out of which we pay the interest. So we need earnings or income before interest and taxes. Now recall that from the income statement, taxes is the last item to be subtracted before we get to net income. So earnings before interest will be before taxes also. All right, so looking at the information provided, earnings before income taxes has been provided as 390,469. But note that we want earnings before interest and taxes. But we're given earnings before taxes. So before we deduct interest, we need to add back interest to earnings before taxes. Now recall that from EBIT, we deduct interest expense to get earnings before taxes, or income before taxes. So we can make that point here, earnings or income before taxes. Then when we deduct taxes from earnings before taxes, we get net income. So what that means is, if we have earnings or income before taxes and we want to get to EBIT, what we need to do is add back interest expense to that to get to this point. So that is what we need to do. So earnings before taxes plus interest gives us EBIT, earnings before interest and taxes, and it is out of it we pay the interest. So EBIT over interest expense, which is 9357, gives us our times interest earned ratio of 5.32. Again, the higher the times interest earned ratio, the greater the ability of a company to pay off its debts. Now let's look at liabilities to equity ratio, or debt to equity ratio. This is a financing and solvency ratio because it gives us an indication of the liabilities compared to the equity of the company. The higher the ratio, the more liabilities a company is carrying. and we can say that its ability to take on more debt will be diminished. We can also say that companies with high liabilities to equity ratio are considered to be more risky. So the ratio is calculated as follows: total liabilities divided by total equity. So let's look at the information provided. We have total liabilities, we have total equity. So we divide the two and we get 3.27. So that is our debt to equity ratio, or liabilities to equity ratio. The higher the ratio, the more risky the company is. Moving on, we now focus on the DuPont framework. Now recall that the DuPont framework breaks down the return on equity into its three component ratios. ROE, or return on equity, has three components. So there are three dimensions to the overall performance of a company. And the three dimensions are profitability, that is indicated by the profit margin; efficiency, indicated by the asset turnover ratio; and then financial leverage, that is leveraging the shareholder investments with liabilities. Liabilities or leverage has its positive side to it. It enables a company to expand. So let's go through the analysis for the DuPont framework. The analysis is for 2011. We're doing the return on equity, profit margin, asset turnover, and financial leverage. So profit margin for 2011, we use net income for 2011, which is 2090, and we divide that by sales, which is 125,987. Now next is asset turnover ratio. Now the asset turnover ratio measures how productive the assets of a company is, or how efficiently the assets are being used to generate sales. The more efficient a company is, or the greater the productivity, the greater the ROE. It's more desirable. So we have sales 125,987 divided by the average total assets. Recall that for the balance sheet accounts, we have the 2-year data, so we do the average total assets. So the average total assets for 2011 will be 2010 total assets plus 2011 total assets divided by 2. So what we have here will be 42,783 plus 37,621 divided by 2 gives us the average. Now the next is the financial leverage, and we use the average assets over average equity for this calculation. So the average assets, again, it will be 42,783 plus 37,621 divided by 2. So that's what we have here. So average assets divided by the average equity. Now the equity is 16,423 plus 15,025 divided by 2. Now, the profit margin comes to 1.66%. Now we multiply the profit margin 1.66% to the asset turnover ratio, which is 3.13, and then multiply that to the financial leverage, and we have 2.56, and the answer for ROE will be 13.30% approximately. So we see that the ROE has three components: the profitability margin, efficiency or asset turnover, and the leverage ratio. Now let's move on to the next question, which would focus on liquidity ratios. Now for Whole Foods Market Corporation, we asked to determine its current ratio and quick ratio. Now, recall that the current ratio is a ratio that measures short-term debt payment ability of a company, and it is current assets divided by current liabilities. Now, looking at the information we have, current assets is 1453144, and we divide it by current liabilities, which is 879361, and we get a current ratio of 1.65. Now next is the quick ratio. Now recall that the quick ratio is a more conservative measure of liquidity, and it is based off on the quick assets, which excludes inventory and all current assets below inventory because they are considered to be less liquid. Now, quick assets will be cash and cash equivalents. Now, cash equivalents are near cash items. These are highly liquid debt instruments like certificates of deposits that have an original maturity of not more than 3 months. They are considered to be as good as cash. So cash and cash equivalents are 212004. We add that to account receivable, but we do not add inventories because we're using quick assets to calculate quick ratio. So quick assets for the company will be 212004 plus 175310. Now the quick ratio will be equal to the quick assets divided by the current liabilities, which is giving us 879361, and the answer is 0.44. So that's the quick ratio, and we see that the quick ratio is lower than the current ratio because the numerator is based upon the quick assets. So this brings us to the end of the analysis of various ratios.